Joining us right now is Roger Hallam, the global head of rates at Vanguard. And Roger, this has to be the most closely watched Fed meeting in years. We know that we are going to get into a position where the Fed is actually starting this lower rate cycle. How much does it matter what they decide today in terms of whether it's 25 basis points or 50?
As you say, I think the decision is very, very close. So it's, markets are priced a little over 50% chance of a 50 base rate cut this week. Our base case is that the Fed delivers 25 basis point cut this week. We think the combination of economy that maintains decent momentum and also the Fed preserving some optionality in case the economic performance diverges in the coming months. We think there's a strong rationale for them delivering 25 bips. Although we do understand why there are others that think that 50 bips is the right option. If you look at the combination of where real policy rates are and the clear slowing we've seen in the labour market over recent months, it's understandable that with policy rates as tight as they are, 50 bips should be an option the Fed is considering.
When you say you think 25 basis points makes sense in case the economic case diverges, you mean in case inflation comes back?
Or in case we get either weaker performance in the months ahead, that gives the Fed greater optionality to speed up those pace of cuts. But similarly, if we also see growth maintain decent strength, we did see a pickup in inflation, or we saw risk assets really perform very strongly, it would give the Fed greater optionality as to how it chooses to pursue policy decisions in the months ahead. A 50 basis rate cut this week markets would certainly run ahead and think the Fed was going to deliver further 50 basis point rate cuts at subsequent meetings.
Yeah, and there's been a lot of talk about that, how it would spook the market if the Fed goes 50 basis points because maybe people will wonder if they know something that we don't. I almost wonder, though, if the market would be spooked at this point if the Fed only goes 25 basis points because the 50 basis points almost being baked in at this point, more people expecting that than not. If it's not delivered, then the narrative begins that the Fed is doing this too slow, just like they raised rates too slow on the way up and let inflation get out of control.
Yeah, the Fed has tended to deliver over recent cycles what the market has got priced. And that's why I think the articles over the past week or so we've seen putting forward the case for 50 are very interesting. You go back to June 22, we had a Wall Street Journal article that clearly guided the market that the Fed was going to be hiking rates by 75 basis points. Now, I think the articles we've seen over the past week are different. They are much more, I would interpret as opinion pieces, setting out the case for either 50 or 25. So I don't think that they're giving such a clear steer. I think you're right to say that if the Fed delivers 50 bips this week, the market would interpret subsequent 50 bip cuts are likely. I do also think you're right that a 25 basis point cut, and if we then subsequently see weaker data, you could get a more adverse reaction from risk assets as they would fear the Fed risks falling behind the curve.
Is there any reason that the Fed should care what the market reaction is? I mean, within reason, you're talking about 25 basis points, not that big deal of a deal one way or the other. We talk all the time about how politicians shouldn't be allowed to bully the Fed, should investors?
Yeah, I think that's right. But I also think even if the Fed was to deliver 25 basis points this week, it would come with clear dovish messaging in that if we did see a further deterioration in labour markets over the coming months, the Fed would stand ready to quicken that pace of rate cuts. So I think you're right from that perspective. 25 and 50 isn't the be-all and end-all this week. It's more about the messaging around the future policy trajectory and how the Fed would respond to economic surprises.
All right, so give us your outlook on where you think rates will be at the end of this year.
Yeah, we think bond markets are attractive here. We think real yields at 1.5% at the 10-year point still offer investors good compensation relative to where we've seen real yields over much of the past decade or so. We think that corporate spreads or corporate fundamentals are sound, and we think the Fed has your back in terms of risk taking. So we are seeing strong flows into bonds, and we think that yields can still fall substantially further if we were to see the economic environment deteriorate, recessionary risks rise. Fixed income still offers a strong ballast within an overall portfolio context. So we still think yields can fall further if we were to see economic conditions deteriorate further, and there's good rationale still to owning fixed income at these levels.
Roger, we mentioned a little earlier that 3 Democratic senators, Senators Warren, Whitehouse, and Hickenlooper, I believe, wrote a letter to the Fed saying that they should cut basis points by 75 basis points at this meeting. Is there an argument for that in your view?
Real policy rates at 3% are certainly very high relative to where we've seen in recent decades. That's why the Fed is set to start easing this meeting and will continue to cut rates at subsequent meetings. But right now, we're not seeing an economy that's on the verge of tipping into recession. So I think the Fed would be well guided to maintain some optionality, proceed gradually, but can always quicken the pace if we do start to see economic conditions weaken.